Picture a massive oil tanker sliding through midnight seas with its lights dimmed and its tracker silent. On paper, that ship barely exists. In reality, it's hauling cargo the world has been told to reject. That's the paradox of modern sanctions. When you bolt the front door of trade, the traffic doesn't stop. It slips through side alleys and tunnels that didn't exist yesterday. Sanctions are supposed to starve a government of money and materials by banning exports, blocking banks, and scaring off insurers and shippers. But markets hate a vacuum, and global demand is stubborn. Shut one route, and price signals start drawing new ones. In theory, sanctions are simple. Cut a country's main revenue, isolate its finance, squeeze its logistics, and watch the pressure rise. In practice, they reorganize incentives. Law-abiding companies retreat to avoid fines or scandal. Prices jump because traders fear shortage. Discounts appear because sanctioned sellers need buyers more than buyers need them. In the wide gap between what's illegal and what's merely inconvenient, a gray zone opens for brokers, traders, and ship owners willing to take bigger risks for bigger margins. That gray zone is where trade gets rerouted. The mechanics are both clever and crude. First comes the identity shuffle. Tankers change names, repaint hulls, and hop flags of convenience, moving from one permissive registry to another so the true owner is hard to pin down. Then comes the vanishing act. Ships go dark by switching off AIS beacons that normally broadcast their position, reappearing days later near a different coast. Ship-to-ship transfers blur the origin of cargoes. Two tankers in open water, hose to hose, and the oil quietly changes homes. Paperwork finishes the disguise. Bills of lading and certificates are rewritten so the barrel that left one port as sanctioned crude A arrives somewhere else as a mixed blend from a friendlier place. Sometimes the workaround doesn't even need secrecy. A third country buys the cheap crude, refines it into diesel, and sells that legal product back into markets that banned the oil in the first place. On a screen, it's compliance. In spirit, it's a loop. Russia industrialized this playbook. After Europe embargoed most Russian crude and allies imposed a price cap, Moscow stitched together a shadow fleet of aging tankers to keep exports moving east. Voyages lengthened around the Cape of Good Hope instead of cutting through Suez. Insurance shifted to smaller providers or vanished. Middlemen multiplied. But the barrels moved to India, to China, to Turkey, often at discounts that made the risk worth it for everyone down the line. A tanker slipped out of a Baltic port, went dark for days, then reappeared off India to offload into another hull. By the time the cargo reached a refinery, the paper trail said little about where it began, and the Kremlin still booked the sail. Iran's Ghost Armada has sailed this way for years. Tankers bound for Syria black out in the Red Sea and light up again off Tartus. Others loiter off Malaysia, swapping oil at night before a different hull carries it onward to China. The flow isn't smooth, but it is persistent, enough to keep a lifeline open and blunt the intended chokehold. Every new rule spawns a new workaround, and the ocean is big enough to hide a lot of steel. Venezuela adds a surreal twist. Phantom ships that adopt the names and identification numbers of vessels scrapped years ago. On paper, they look legitimate. In reality, they're anonymous, creaking tankers hauling discounted crude across the Pacific. If a buyer wants the oil and a ship can plausibly deny its past, the trade happens outside the neat boundaries regulators drew. All of this has consequences you can feel even if you never touch a dock. Rerouted trade is longer and riskier. More miles at sea mean more fuel burned, more crews pushed, and more chances for things to go wrong. Old, lightly inspected tankers are accidents waiting to happen, especially in chokepoints like the Strait of Hormuz or the Suez Canal, where a single grounding or collision can snarl world shipping and jolt prices overnight. Insurance markets react in minutes. Freight rates jump. Headlines do the rest. There's also a quiet tax you never see itemized: inefficiency. When sanctioned oil detours around Africa, rides a parade of ghost ships, or is refined in a third country before returning to the very markets that banned it, the total cost of delivering the same molecules to the same drivers and factories goes up. Some of that cost lands on middlemen who take the risk. Some lands on consumers who never realize they're paying for the longer route. So, do sanctions work? They raise friction. They force hostile states to accept worse prices, longer routes, and higher risks. They deter law-abiding firms and chip away at revenue. But they also push trade into the shadows where monitoring is hardest and side effects. Environmental danger, price volatility, diplomatic strain are largest. Enforcement becomes a treadmill. Blacklist one shell company and another appears. Sanction one hull and its twin sails tomorrow under a new name. Policymakers respond by widening rules to cover services like insurance and shipping, or by using satellites and data analytics to spot dark behavior faster. Traders respond with new shell firms, new flags, and new meeting points in the open sea. It's an arms race of paperwork and persistence. The real question is whether we're comfortable with where commerce goes when it's forced underground, and whether the strategic gains outweigh the hidden costs we all share. The tanker in the dark still moves. The money still changes hands. The route is longer. The risk is higher. And the audience for this drama is everyone who flips a light switch, fills a tank, or buys a product that crossed an ocean. Sanctions close doors. Global demand opens windows. In between, a maze appears. And that is where the world's trade quietly reroutes itself, night after night, far from the headlines but close to your life. If this helped you see the hidden routes behind the headlines, tap like so more people find it, and tell me in the comments, should sanctions hit ships and insurers harder, or would that make the maze even more dangerous?